So they took a study of stocks for 50 years before 1986. They classified each year companies into two buckets, a winner portfolio and a loser portfolio.
Okay.
Winner portfolio had 35 companies which were outperformers or the best performers of the last 3 years.
Okay.
And the loser portfolio was of the worst performing, underperformer 35 companies of the last 3 years.
Okay.
And they held this portfolio in simulation for 3 years.
Okay.
Now, if they were right, then these losers should outperform the winners in the next 3 years, subsequent 3 years. They found that the underperformers, the loser portfolio, is outperforming the winner portfolio quite handsomely.
Nimesh, I often find people talking about the winners in their portfolios, but nobody really talks about the losers. And there are many a times that people get this impression when they see charts going up, this company is good. And the minute the charts go down, company becomes bad. So what is your, understanding of this event that unfolds every time?
What you hit upon actually is a very interesting bias called the representativeness bias. Let's take an analogy from sports this time. In baseball, in 2001, there was a team, Oakland Athletics, who was not doing very well in the league. Their manager, Billy Beane, had to form a team. He had very limited budget for it. Their star players were actually leaving and joining another team. So with a limited budget, they had to create a team which has a chance to win. And this was a difficult task. During those times, players were selected only by scouts. So scouts were talented or experienced players themselves who after retirement would help a certain club identify new talent for them. Typically, scouts would also go with what is glamorous, a player who's done very well recently and it's an all-star that people would want to take them. But Billy Beane got outbid by other competitors in those star players. So they developed a system of analytics which showed which are the players which are good but are undervalued by other players or other teams were letting go of them. Many of these players were not selected by scouts because of certain bias or certain traits that they had. Some were old, so because of age or certain personality trait, they were being rejected. In fact, when Billy Beane created a team of these undervalued players, their own scouts used to say these are defective players. So they used to not like them. Like you mentioned, stocks that were going down on the chart. Right? Now, this team actually of players, they created a record of winning 20 games in a row, which has never been done earlier in baseball. And all this they achieved at a fraction of a budget that the other teams had when they were chasing glamours. Same thing happens in the markets also many a times, that people undervalue certain companies or stocks which have not done well recently. So in markets also many a times, these underperformers, as we call it, tend to outperform the biggies or the stars, glamour stocks.
Is there a Billy Beane strategy for investments then?
Of course it is. Let's say the scouts in the baseball side of the example, they were looking for glamour, right? They were chasing glamour and paying very high price or unreasonable price for getting those stars in the team, who many of them did not deliver the runs that they wanted. In markets also, you see that people chasing glamour and stocks which have done well, as you said earlier, that chart is going up, so people think it's a good company, let's buy and want to make a quick profit from it. Also, people feel comfortable being with the crowd, herding as we call it, that they feel good to be in the warmth of the crowd. This makes them comfortable, but it doesn't make them get super returns. As Warren Buffett said, that what is comfortable is rarely profitable. And the opportunity then lies in what is considered to be an underperforming stock or an underperforming company. Many of these companies are good companies but going through some short-term trouble. And Benjamin Graham in Intelligent Investor says that markets have a habit of making mountains out of molehills. Even if there's a short-term trouble for the company, people overreact to it. People take the price down substantially. And then for most of the media or investors ignore such companies because they have not done well, they don't show up in any screeners for them, so on. It is an opportunity to buy some of these companies who, when in some time things get back to normal, the prices and valuations revert to the mean and you make very good gains. In fact, many a times then people chase it to overvaluations also. So these underperformers actually become good hunting grounds where crowd has overreacted on the downside, but you find some of these companies only trapped in a short-term situation, and then they can revert to mean quickly.
Oh, Nimesh, you make it sound very easy, but I bet it's not.
Yeah, so it sounds simple, but it's not very easy. You require two things to remember for this. One, it requires a lot of patience. Just because a stock is a loser, it doesn't start outperforming, and a stock which is a winner doesn't start underperforming. It takes time for these overreactions to come into the price and then reversals to start. The second point is that not all losers become winners and not all winners become losers. So they don't mean revert exactly. Richard Thaler and DeBon did a study on this. They took data of more than 50 years of the stock market. This paper was published in 1986. Their hypothesis or the question was, do markets overreact? And if they are overreacting, then these reversal patterns matter. So they took a study of stocks for 50 years before 1986. They classified each year companies into two buckets, a winner portfolio and a loser portfolio. Winner portfolio had 35 companies which were outperformers or the best performers of the last 3 years. And the loser portfolio was of the worst performing, underperformer 35 companies of the last 3 years. And they held this portfolio in simulation for 3 years. Now, if they were right, then these losers should outperform the winners in the next 3 years, subsequent 3 years. They found that the underperformers, the loser portfolio, is outperforming the winner portfolio quite handsomely. They repeated this test for 5 years and the results were similar. So they found out that this representativeness bias is leading to certain outperforming companies being termed as glamour stocks or the companies to chase or be with. And people used to have fear of missing out if they didn't buy them. On the other side, there were these underperformers that people didn't want in their portfolio, were considered to be bad companies. They had become so cheap that they were vulnerable to any good news that comes in. So the price used to shoot up whenever some good news came in. So this study is very important in actually identifying how and when you actually pick up the underperformers.
But then, is somebody taking on too much risk by buying into losers or, the bad companies, as we call it?
So a lot of academics who actually like the efficient market hypothesis, they actually challenge this observation that you're buying losers, so you're taking more risk. So let's split risk into two parts. One is risk of actual loss, and the second is risk as termed by markets as volatility. Now, where is the risk of loss higher? In a certain glamour stock where valuation is very high, people's expectation of the future are very high, everybody has loaded up that stock in the portfolio, people expect this to continue delivering good returns for the future. Or the risk is high in a company which is an underperformer where valuations are low, people don't expect much from it from the future or so. I think the risk is high in some of the glamour stocks. It's not that winners are risk less, but you have to actually do certain fundamental analysis to come to whether the business is good and they're going through some temporary trouble. The second part is volatility. Richard Thaler, in his study, actually later on, he did a revisit to that study and he actually showed that the beta, the volatility of the loser portfolio was lower than the winner portfolio. So this actually removes that risk of volatility when you're looking at underperformance. But the ideal way to reduce your risk of picking up some of these companies is that you combine analytics and your fundamental analysis. A lot of baseball clubs, after Billy Beane's experience, actually started doing that. They combined the expertise of their scouts with analytics to get better results. So it's the same way investors can also actually hunt for value or ideas within these underperformers, but combine it with a good understanding of their business and management, and then take a bet. That improves your chances of making good returns from these underperformers.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.